continually taunted Labour that her energy bailout was bigger than Keir Starmer's. But now Jeremy Hunt is admitting that in order to make the books balance, they're going to have to make it more targeted support. It was a huge criticism of the bailout that people who didn't need money were getting it, but really the hope will be that this will calm the markets a bit, balance the books.
Do we have to pay royalties to the Benny Hill estate?
Is that what that is? Is that Benny Hill?
I believe so.
Very good.
This is our soundtrack now on Bloomberg's surveillance.
Tune, you know.
Lizzie, this probably works for the whole conversation on this programme daily.
Lisa will remember.
Go on, Lizzie.
When Lisa and I were on the day of the mini budget, he was playing Money, 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 because that day it really was a rich man's world.
Lizzie, let's get to late October, early November, and tell me what more we can expect from this Chancellor at the end of this month and what it means for this Governor at the start of next month.
Well, he needs to balance the books, and this what he's announced so far is expected to save £32 billion. But in terms of the black hole that is left, the OBR was projecting a medium-term fiscal hole of £70 billion, so it still leaves 38 to get debt falling as a share of GDP in 3 years. What you might also see is a rowing back on some of the supply-side reforms that were really, really controversial, the other side of Trussonomics that just aren't likely to get past the parliamentary party. And when you get to that stage, you have MPs asking, what is the point now of having Liz Truss at number 10 at all? The answer when I'm speaking to MPs in Westminster is very much it's a question of when, not if, she's going to go.
Lizzie, I got to say that the music really adds to this feeling that we were talking about on Friday, that it feels rather circus-like in terms of the whole upheaval. Is there any chance that Liz Truss keeps her job? Is there anything that she's doing now, especially as she cedes some control and frankly, the helm to Jeremy Hunt to really paint an agenda that's a lot different than what she had initially put out there?
Jeremy Hunt is her only hope now, which is ironic given he doesn't have Treasury experience, he doesn't have broad support in the party. Remember, he's already had 2 failed leadership bids. But as you say, he's in the driver's seat, which is why lots of MPs are questioning whether they should just crown him as Prime Minister. But that would mean either another leadership election or bypassing the party membership, which would be ugly in either case. If there's a new leader, the mandate would be severely diluted. That would add to pressure for a snap election. And if you look at the polls at the moment, Labour would completely wipe out the Tory party.
Lizzie, enjoy the music, won't you? And find out if we need to pay anyone. Lizzie Burden, thank you. Down in Westminster. Mr. Stolfus over at Oppenheimer, he has thrown the towel in. Here's the quote from him and the team. We are updating our year-end price target for the S&P 500 based on the index's closing level of 35.83 last Friday. We now see just under 12% potential upside in the index by year-end to establish a target of 4,000. I think you all remember the previous target. I'm trying to bring it up right now. I believe it was something like 5,300 at one point from Mr. Stolfus. And Tom, that is gone.
This is the issue, and he's a grizzled pro, and he's been dead on in the great bull market. But if you put a level and a time on it, always you get in trouble. So I would suggest, we haven't spoken to him yet, but I would suggest he's extending out his optimistic view.
The last target we saw from John was 4,800. And that's now down to 4K.
Yeah, because the calendar's moving on. Year end is tomorrow.
Who's left?
Oh, I don't know.
Just to give up on this thing.
One person, Marco Kalanovic.
I thought he kind of gave up and said there's risk now you achieve that in 2023.
He pushed it out, but he didn't abandon the call.
Okay. So what do you do now? I'd love to know. I'd love to talk to someone on the South Side. It's got no problem with getting it wrong.
No.
You know, people get it wrong sometimes. What do you just hold on to it for a couple of months?
You extend your time.
Or you just say next year?
X-axis, X-axis, X-axis.
My question is, how much can you really extend out when you have a Fed that has to move more aggressively simply because of the resiliency that we've been seeing?
Talk about fixed income with Bob Miller of BlackRock. That'd be nice. That's just around the corner. Live from New York City. This is Bloomberg.
you're lifting the barbell, you get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Live from New York City this morning. Good morning. Coming off the back of a week of losses on the S&P 500, just about after an ugly close last week on Friday. Bouncing back this morning, futures up by about 1.2% on the S&P, on the Nasdaq up by 1.4%. Helped out by the bond market, 2s, 10s and 30s. Yields come in, they drop away after kicking out higher, much, much higher over the last 6 weeks on a 2-year, through 450 briefly last week, on a 10-year yield climbing for 11 consecutive weeks. Your 10-year right now, 394.67, having a little look at a four-handle a couple of times over the last week and then backing away. The bond market in the UK, all over the place. We can take a look at gilts, 10s and 30s. Remember, the 30-year plus is where that gilt market operation was taking place. Well, that gilt market is helped out by this Chancellor this morning. Yields aggressively lower off the back of a reversal on tax cuts and even backing away on the duration of support they will offer to consumers in the UK around the energy crisis, and I think we can call it that. It will now go to April 2023. It was initially slated to last 2 years. Will they have to backtrack on that or revisit it later on? But ultimately, TK, we heard from the Chancellor. I think it's pretty clear the direction of travel here from this particular individual, and it's very, very different to Chancellor Kwarteng.
And it's about accommodation and restriction, and the Bloomberg Financial Conditions Index for the United Kingdom showing a new restriction. John, moments ago in the United States, the Bloomberg Financial Conditions Index shows new record restriction except for that COVID moment.
And Tom, that's the goal. It's the objective.
Yes, absolutely.
To get it there, keep it there, and wait for inflation to come down.
Yep.
And the problem they've got as a committee right now, and it's no good me sitting here and saying what I think they should do and what I see, it's what they tell us they are seeing. They believe in their minutes, Tom, that the risk of doing too little is bigger than the risk of doing too much. Many people on that committee believe that, Tom. That means they think they've got more work to do, and until they see inflation coming down in a more convincing way and cracks in the economy, which many people assume aren't there yet in a material enough fashion, Tom, to get them to back away.
I'd watch housing. That's all I got to say.
I'm with you, Tom.
The housing,
sure.
This is nationwide. It's not just about the big cities.
Tom, I think the phrase I've heard is housing recession. You get a housing recession, and somehow the
but if you, John, if you own the house and like Matt Miller, you bought it at the top of the market, it's not a recession, it's a depression.
Have you spoken to Matt?
I have. You know, it's 8,000 square feet, 8 bathrooms. A lot of people sharing
that pain. Well, get Miller on the show to talk about that himself, TK. I'm not going there. That's the cross-asset price section. Let's get you some single names. We can do that with Lisa this morning. Hey, Lisa.
Hey, and I will say that depression is probably leading more people to stay put and not be as mobile, since they do not want to sell their homes at this point and see the repricing. What I'm watching right now is a series of earnings showing the haves and the have-nots. And this really can be seen in the airline industry in particular. United Airlines coming out tomorrow after market with their earnings. And we heard from Delta last week how much you're going to see those airlines that actually cater to some of the business travelers and some of the upper end kinds of travelers do much better than, say, the JetBlues of the world that cater more to the vacations. United Airlines is up 1.9% ahead of the open. Delta up 1.7%. JetBlue lagging behind, but also up 1.4%. But year to date, you can see this divergence more clearly. And again, I keep coming back to the reason why this earnings season is going to be so difficult to come up with some sort of overarching conclusion, because you see pockets of strength, and a lot of those pockets of strength are dictated by the areas that cater to higher income individuals and businesses. United Airlines down sharply, but less than 20%. Delta down similar. JetBlue, Tom, down more than 50%, catering to Florida, catering to a lot of families, catering to vacations at a time when people are rethinking whether they really want to fly around. Because if you check out some of the airplane tickets, they're incredibly expensive, and the marginal money that people have to spend is declining pretty quickly.
My memory, this is all David Rosenberg, but my memory itemized, Lisa, was airline fares last inflation report were up 42%.
Exactly, and a lot of this stems from the business travel and people who can afford it, but a lot of people can't. And I know anecdotally of so many people who have canceled or not gone on vacations at this point, or just driven, because it is punitive for people who actually have some constrained discretionary income.
It'll be interesting to see on the cash flow front and earnings front how they do. Right now, and this is a joy with the chaotic weeks that we've had, in a Monday into another week of chaos. Bob Miller joins us. He's head of America's fundamental fixed income at BlackRock with decades of experience. Bob, I want to cut to the chase in the great bond bear market. What is the level of pain on level? I was talking to Axel Weber in Washington, and he said, forget about the numbers, the spreads, look at level. Bond prices are down. What does it signal?
Well, Tom, I think that's a great point about spreads versus all-in levels. So the cost, debt spreads, for example, IG and high-yield spreads aren't at recessionary wides that we've seen historically, but the all-in cost of capital has gone up substantially, right? And in the investment grade space, you're talking about an index that's now a 6% yield. And in high yield space, you've got companies that were funding a year and a half ago at 4 to 5% that now can't get funded inside of 10 and may not be able to fund at all. So the cost of capital has gone up substantially. And I understand that there are a lot of really good, savvy liability management strategies that firms employed and households employed by refinancing their mortgages 2 years ago, and that they've got these very attractive liabilities on the balance sheet. But the incremental spend, right, the next thing that one might invest in, whether it's residential or commercial, is going to be substantially more expensive from a debt capital standpoint.
Let's talk about the great Dan Fuss at Loomis Sales, and he would say, that's great, you've got the free lunch of a high nominal yield, but do you buy that nominal yield into reduced credit quality across all of fixed income assets? Is there credit clouds out there that make this not an easy decision?
Yeah, I think so. I mean, look, you guys were just talking about this. The Fed is on a mission. This is a very intentional and aggressive tightening of domestic monetary conditions in an effort to slow growth, slow demand, specifically loosen up the labor market a little bit to get inflation back to target. So definitionally, there are going to be some things that probably break along the way. It'll be really, really hard to do it without some of that happening. But I also think at the same time, here's one of the interesting things. Volatility is so high in the rates market right now that it's really hard to look, 3 months forward or 6 months forward. It's hard to look more than 3 to 6 days forward because the vol is so high, right? But I think if you can take a step back and think about the valuation of high-quality fixed income assets today, you can build a pretty reasonable portfolio. Treasuries, agency mortgages, investment-grade corporates, where you can go in and do the name selection so that you can avoid some of the more stressed or potentially forward distressed names. You can build a high-quality portfolio, intermediate maturity, in the 5 to 6% range, including treasuries. So you've got a flight to quality asset in there in a shock scenario. We haven't been able to do that in nearly 2 decades.
Yep.
I mean, things are starting to look reasonable. I get it that we're probably not at the bottom. and there's more stress to come, but things are starting to look pretty reasonable if you can take a longer time horizon.
That is the key point. If you could take a longer time horizon, and I wonder about some of these mutual funds or open-ended funds where there could potentially be withdrawals, especially when it comes to investment-grade credit. It makes sense perhaps on a thesis basis, but on a real basis, investment grade is underperformed dramatically because of the rate story as well as this forced selling that we've seen from international investors to sell what you can, not what you want to. How much are you concerned about that creating some sort of fissure in the short term as you see things like what happened in the UK force some selling?
100%, Lisa. That is exactly the right thing to be focused on. We've seen this movie before, right? When you tighten financial conditions this aggressively, this abruptly, things are going to break. And where do they break first? Almost always, it's in the levered strategy, the levered business model. You know, I would argue in the UK that yes, the push toward, a much more aggressive fiscal policy kicked off more pressure in an already deteriorating market. But the proximate cause of the real stress in the long end volatility was the levered LDI business model and the increased margin calls, right? So if you're levered, if you have to borrow to sustain your strategy, and importantly, if you have to pay higher margin costs, to maintain your leverage, you're in a really difficult spot right now. So those business models, kind of should be stressed. And I wouldn't be surprised if we don't see some more of that before this is over the next 3 to 6 months.
Bob, thank you, sir. As always, Bob Miller there of BlackRock. Just picking up on the UK at the end there. Got a 113 handle again on sterling against the US dollar in the gilt market. Let's pick out 30s because that's where the Bank of England was sitting, 30s and above. Your 30-year yield is lower, Lisa, by 42 basis points this morning.
And this feels more fundamental than some of the other questionable moves that we saw last week in response to temporary programs from the Bank of England. This is generated by a true fiscal response that people seem to like. There are some more details coming out. It is clear that Jeremy Hunt is leading the charge. Now we get more details at 10:30. How much does that really edify some of these moves and send them further down? And where are the scars?
I think if this inflationary boom, Tom, is followed by some kind of disinflationary bust, that the policies that were announced in the last couple of weeks in the UK will potentially be revisited in the years to come, Tom. If we start to suffer with growth and have much more of a growth problem than an inflation problem, and to Steve Chevron's point of Federated, if we can get yields starting to come lower and not climbing, a lot of people might be clamoring for these kind of initiatives.
That is a study of history. I went back and I mentioned David Rosenberg earlier, and there's others besides Mr. Rosenberg who say, yes, you get this inflationary bout and it takes care of itself, and you get a disinflationary trend, and you look back to 47, to the Eisenhower deflation of 52, 53, you can actually get true deflation, albeit just for a little bit of time. But the point here is if you come on the U.S. continuum from 9%, what is the path and stopping point on the way to their vaunted 2%? That's a mystery.
Do you think the inventory story of the Nikes of this world, Micron, I think it's part of that? UBS warning about Ford, GM?
Tangible, but secondary. Dana Telsey with a blistering note this morning that the only thing that's working is luxury.
Well, except that services continues to climb. So how much does that offset the disinflationary force that you're talking about? And I've seen the discounts. They're not that big. I mean, have you seen the discounts?
Is that aimed at Target or Nike?
Nike more.
You're upset with Nike?
I'm not upset
with...
You
don't think they're good discounts?
I'm just saying, theoretically, if a child really liked, Air Jordans and the parent was still saying no, they're still possibly going to still be saying...
That's not real. That's just...
No.
That's not real? Or is that is a real conversation in the Bremo household?
No, I'm just saying it's theoretical.
No, it's just in case you were a mother who had a child who wanted some...
Correct.
Some Nike.
Yeah. They're still really expensive. I'm just saying.
Would you explain to me why Comme des Garçons has a Converse sneaker
that costs 10 times as much as Converse sneakers?
I had Connie's. I had Connie's. You had Connie's.
This, of course, isn't an actual conversation either.
We need the little red heart thingy on it.
None of this is going on at Keene and Casa Bramo.
None of it.
Of course. All right.
No.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Newly appointed UK Chancellor Jeremy Hunt has set out plans to try to bring order to the public finances and reassure markets after Liz Truss's economic programme triggered weeks of turmoil. He announced a further rollback on some of the tax cuts planned by Truss and a shortening of planned universal energy support.
No government can control markets. But every government can give certainty about the sustainability of public finances. And that is one of the many factors that influence how markets behave. And for that reason, although the Prime Minister and I are both committed to cutting corporation tax, on Friday she listened to concerns about the mini-budget and confirmed we will not proceed with the cut to corporation tax announced.
Meanwhile, Hunt will address Parliament with even more details later today. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
What I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
We've got terrible sentiment on Wall Street, not much better sentiment on Main Street, and we've got a Fed that's orchestrating a monetary policy that just seems clearly unsustainable. It just can't last long. It's going to break something.
That was Jim Paulson, the Chief Investment Strategist at the Luthold Group. Always great to catch up with Jim. I do stray, Tom, myself into the should, shouldn't conversation around the Fed, what they should do, what they shouldn't do. Ultimately, we have to talk about what they will do. And most people assume what they will do is hike again, Tom, in November by 75 basis points.
And again, now is when the lifting is difficult. I mean, it's all been easy. We've talked about this. I think we've been way out front on easy decisions. And now is where it matters, where you're out one meeting, two meetings, even in the first meeting of 2023.
Jamie Dimon said of JP Morgan last week to Juliana over at CNBC, the next 100 basis points, Tom, is the most painful one.
Yeah, and there's the then what, and I'm sorry, they're just data dependent. I'm not spending too much time on it versus the challenges of the Powell approach to the rest of the world. Yen 148.84. What do we do with a 149 yen?
Problematic.
Yeah.
It's why intervention doesn't work, does it? I mean, come on, TK.
No, it
you
doesn't
come
work.
in for a little bit and you don't scare anyone off.
And even coordinated intervention, which is a rare occurrence, is a difficult. Not a rare occurrence is a discussion with Leland Miller of China Beige Book to illuminate on China. He is just outstanding, the co-founder and CEO of the hugely prestigious effort. Leland, I got to go to the immediate news. The great George Magnus over in London today says he's never seen anything, even in pestilence and conflict, like a postponing of China GDP. This is your wheelhouse. What was your response when they postponed Q3 GDP?
Well, look, I think the most obvious reason is that they are very busy on the party Congress. You know, you saw all those pictures of people in rapt attention at jails and statistics bureaus just sitting there very, very silently and without moving, watching Xi's speech. They probably just can't work because they're too busy listening. But, you know, I don't think there's anything terribly nefarious behind it. You know, we see what the data are weak. They've been admitting the data are weak. You know, I think this is probably making sure that there's not just another bomb dropping off in the middle of a very choreographed event.
Forget about the choreographed event. What happens in the unchoreographed 2023 to the new dynastic Xi?
Well, look, it'll take a few months for Xi to formally get the three positions. And so the question then will be, you know, where does he pivot, if at all? Everyone wants to see a pivot on COVID zero. There's been no indication that pivot's coming. You know, you could see how they would do it, the rollout in 2023. But you know, it's not just announcing COVID zero is over. It is saying, you know, here's the policy. Here's how we're going to do the rollout. Here's how we're going to deal with the fallout. And it's not at all clear that this isn't a many month, maybe year long transition. So is she going to pivot on the economy? Probably not. Is he going to pivot on COVID zero? At some point, yes, but probably not soon.
Weren't there some small pivots, though, Leland, within this speech, basically around having a more business-friendly environment, both for national and international companies?
Yeah, look, I mean, it's hard at this point to see what's talk and what's not. I mean, if you remember how excited investors got all throughout 2022 when, you know, some party official, Li Keqiang, would come out and say, look, we're doing this differently, or we're easing this crackdown, or we're going to provide this stimulus. And nothing meaningful ever happened. So we'll have to wait and see. I think it would behoove Xi to have some sort of outreach, particularly with the U.S.-China tensions to the Europeans. I think you're going to see some of that going forward. But in terms of making China more appealing to investors, you have to have regulatory certainty. You have to have some sort of idea of growth. You have to end COVID zero. You know, there's a lot of obstacles. It's not just saying we're going to be friendly.
Yeah, the idea of growth is key here. Economists predict that Chinese growth will slow to 3.3%. So this year, a lot of people say that that's probably a highball estimate. I'm assuming that you probably think so, given that you've talked about a two-handle. The official target is 5.5%. The gap between those would be the biggest since they started setting GDP targets in the early 1990s. How much do you think that this is going to be a problem for this government, where they start to inject more stimulus and start to support the housing market, versus a reality of the new China in a new regime with a bigger middle class?
Yeah, I don't think it's a problem at all for them because I think once they descended into lockdowns in the spring, the 5.5 handle was not only gone, but even the fake let's pretend that we got somewhere near 5 was gone. So look, they can blame this on COVID zero. Yeah, it's their fault, but there's a reason for not hitting these numbers. And the larger thing is that they've changed their priority set. So yes, they still talk about high levels of growth for some reason, although the narrative's changing, particularly in the last couple of weeks. But that's not what they're focused on. It's not what they're worried about. They're going to try to deliver enough growth so they don't have a political problem. But the reality is they're trying to do some structural changes that are very painful, and they're not going to be worried about hitting the high levels of growth anymore.
Leland, a 720 yuan gets you out not to 2005, but it just all of a sudden gets you out to a new weak renminbi strategy. What's the level of renminbi where that unravels? Do you have in your head a 7.XX level that this becomes difficult?
I don't, because it's a dollar story, not a yuan story. If this were sort of a renminbi exploding because of the weak Chinese economy while the dollar stays pat against other currencies, you'd have a different dynamic. People would read into it differently. Right now, everything is weakening against the dollar. So the Chinese goal is to maintain relative stability, relative strength as much as possible against the rest of the world, but making sure that things don't break on the way up. So they want stability. There isn't a number. It all depends on how strong the dollar gets over the next 6 to 12 months.
Leland, thank you, sir. Always important stuff with Leland Miller. He's great, isn't he? Leland Miller there at the China Beige Book International.
Yeah, when I first met him, he was looking at utility costs, electric stuff, and completely refuting statistics. I think he would say the statistics today out of China are, on radio, I've got quotes around the word believable.
That works.
I think that works.
Can we just say it's better now, Lisa, than it was maybe back then?
Yeah, although they just entirely scrapped the ones that were due tomorrow. So
well, at least they're not pretending.
Exactly. So there's that in terms of how far. Exactly. So they're not pretending, but they're just not disclosing it because it might not be what they want to say.
Do you think on net, and I think this is an interesting thing to ponder, is COVID zero good for the global economy or bad for the global economy? I get it from the supply side of things, and we spent a lot of time talking about that over the last 2 years, but Tom, you've said it a million times about the demand side. Can you imagine if you had that full throttle demand out of China and what that would mean for this labor market?
It's just bad science.
And the inflation story.
I don't even take it over to economics, finance, investment, blah, blah, blah. I need somebody who's an adult, like at Johns Hopkins or all the other great epidemiologists and virologists we've talked to. The fact of the matter is it's bad science.
But he doesn't care about that. We've got to do the blah, blah, blah. The fact of the matter is this is the policy, and we've got to work out what it means.
Will there be an end to the policy is the hope.
Sure.
I did not hear that from Leland Miller.
Although, to your point, John, if they scrap it, what does that do to gasoline prices? What does that do to diesel prices? What does that do to natural gas prices? This is really the question. At the same time, does it help some of the supply chains? That's a question I'm curious about.
I don't know. It's been so long since I've been. It's great to be back.
That's the cameraman.
Yeah, I know. The tang is still, but other than
Are you confused by the fact there is an individual holding a camera?
No, I'm not. I just,
How long have you been away?
Long enough for the tang to go bad.
Have a cameraman down in DC?
Right here. I need fresh tang.
Keep up, TK. TV, radio.
Pictures.
You here? Present. Good.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
Under the circumstances, the Fed's going to keep continuing to raise rates aggressively till they see the need to slow down.
I think the Fed is going to continue to be on this path for quite a few months.
I definitely think we'll see another 75 basis point move in November.
The more aggressive they get, the more you're going to bring recession fear as the primary fear over inflation.
Because of the Fed overdoing this, we're going to end up back where we were 10 years ago.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. On a Monday, just like all the recent Mondays, chaos out there on radio and television. All I can tell you is futures up 44, Dow futures up 303, and it doesn't matter, John. We're still looking at goofy stuff like foreign exchange and bonds.
Chaos in here or chaos elsewhere?
Both. Chaos everywhere. Padres won, Leni alone.
Was that chaotic?
It was really chaotic at the end. It is the second largest comeback or beating, I should say, of a ranked team like the Dodgers
did
since
Padres
1906.
win or did the Dodgers lose?
Dodgers lost.
Dodgers
no question.
lost.
Adore the Padres, but the fact is the Dodgers, like the Mets, were in a fog.
Do you want to squeeze Spurs in there too, or are you done on the
I think
sports
Spurs
side?
did okay.
Right.
What I want to
I'm
move
just
to
checking.
is United Kingdom here in 2.5 hours. What's a so what, John? About 10:30 this morning for Global Wall
The
Street.
vigilantes won, plain and simple. We haven't seen this, I think, since the Berlusconi government back in Italy in the Eurozone debt crisis, where the debt market, financial markets, foreign exchange have pushed back so severely it's forced the government to do a complete reversal U-turn on pretty much everything
I
they announced.
saw this, John, this weekend. I would not use it. It's inflammatory, but with AC Milan doing so well, I can come there.
Thanks, Tom.
Is the United Kingdom on the edge of becoming Italy?
I don't think so. It's got its own central bank doing its own thing, and I don't think it quite compares to what happened in the Eurozone debt crisis. I do think, Tom, in this situation, this government has been forced to do something it did not want to do. And I will even go further, because I don't think it's even controversial this morning, Tom, in the UK. The Chancellor's leading this country now, not the Prime Minister. These policies are his, and perhaps even Rishi Sunak's. They're certainly not the policies of the Prime Minister Liz Truss.
Lisa, let's bring it home. We just sum up all this international blather, including the wonderful discussions in Washington. Great. But for regular America, to me, they're being almost left behind by the elite conversation.
When you say regular America, you're talking middle and lower income
People that
individuals.
are looking at rents up, mortgage resets, they're looking at tuitions up, and food.
And right now, Bank of America CEO Brian Moynihan is talking in the earnings call and saying that the resilience is still there. That, yes, you're seeing consumers continue to spend, albeit a little bit at a slower pace in terms of the growth. However, this really is the dissonance. Where, right? And are there entire segments of a population that cannot continue to keep going with this? And what does that do to consumer expectations? John mentioned earlier, Tom, that report that we got out on Friday about the 1 year ahead inflation expectations as reported by the University of Michigan.
Gripping stuff.
I know. You dismiss it because it's 500 people that they call and you've never gotten called. But I do wonder if this is significant because it does signify.
Just set the scene.
Yes.
You get one of those phone calls from the University of Michigan. What is that, Ann Arbor? Is that right, Tom?
Yes.
You get the call out of Ann Arbor. Okay. So they give you the call and they say to you, where do you think inflation is going to be 1 year from now? Is that actually how that goes?
I don't know.
And they say
I have
5%.
never received it. I don't live in Michigan. I don't receive that. I don't know if it's just Michigan. But listen, they've actually been somewhat accurate in terms of reflecting the zeitgeist in America. And how much is this simply, and as you stop laughing at me, that this is just looking at the gasoline prices and then, getting
Did you see
influenced
Pharaoh
by that.
in the AC Milan shirt?
At home on the phone.
The flip-flops with a beer in his hand with Liverpool on in the background going, well, let me think about
I'll tell you exactly where inflation is going to be 1 year from now.
Let me check the Fed funds
gasoline
futures.
aspect of this is clearly a factor.
Yes.
Gas prices have bounced
And
back,
diesel.
Tom. Look, we spoke to, who was it we spoke to around the jobs report? Randy Krosner.
Yeah.
And he said, no, John, they target PCE, core PCE. I said, give me a break. Chairman Powell's told me to look at ECI. That's why he did the pivot back in late last year. He told me to look at Mitch. That's why we're going to come in with a bigger rate hike than expected. And that's the problem with the Fed right now, Tom. We can sit here and say what they should and shouldn't do. It's what they are doing, and they've told us they look at this stuff.
Rob Waldner going to join us here in a bit from Invesco on the challenges of institutional bond investment. John, I want to dive into the data, and I'm going to lead with the Bloomberg Financial Conditions Index is at negative 1.50, which is the most restrictive except for February, March COVID. That's stunning.
And that's been the story and the objective to Bob Miller of BlackRock's point. Futures right now elevated. Bank of America doing okay in the pre-market as well, up by about 2.7%. The bank so far telling us kind of what we already knew, which is the economy's resilient, the consumer's doing okay. We're building up provisions because we think there might be a storm on its way. That seems to be the story of not just the earnings season, but the commentary of the last 2 months.
And the VIX 32.11 really doesn't move. We need that below 30 to give us any kind of good feeling. What else do we see, John?
Nothing. I haven't got the Dow on my board, Tom. Where's that?
The Dow's up 283 points, 29,993.
I see complete chaos. That's what you said.
Do we get Dow 30K hats?
We do.
Revisit?
No, not 30. 40K you got there.
Protest. You would storm off.
Do you know how much you'd have to pay me to wear one of those things?
How much?
Like serious money. $10,000 for charity, and I'd do the show in a Dow 30K hat.
Everyone take note.
10,000. If you can raise enough money for it, there you go, and we'll give it to a good cause. People who need re-education about using a Dow and perhaps allocating to the S&P 500. Okay.
John, it's like the autumnal leaves glowing from Labrador down. Lisa did the leaf peeping thing this weekend. It's the glow, John, of our heritage.
Is that an actual term, leaf peeping?
No, it is not.
Yeah, it is actually leaf peepers. Retirees. They're on buses.
Okay, you're scaring the hell out of me. Old people that peep leaves.
Yeah. I'm a leaf peeper.
Please,
I don't think you want to admit that.
Can you see me on a bus up at Bretton Woods at Mount Washington? Oh, they're
peeping
so
leaves.
beautiful.
It was really crowded.
Yeah, they're called leaf
That's not a term.
Is that a moose?
That's not a term.
It sounds wrong.
Okay.
No.
Right now, we're going to try to salvage a show. We do this with Robert Waldner. Rob Waldner is Chief Fixed Income Strategist and Head of Macro Research at Invesco, and he joins us, I hope, this morning as well. Rob, you do big institutional money. It is a bond bear market. How do you extract yourself from the price declines you've enjoyed?
I think, Tom, the story is 100% right. It has been a bond bear market. But underlying that, if we think about it, we've seen such increases in yields. I mean, real yields have gone up in the last couple of months, 150 basis points or so, that we're really offering value. So the question, I think, should be reframed, which is, for the first time, we have quite a bit of value in fixed income. And, that's where we think clients can start to generate, to lock in longer-term returns. And we think that's a compelling investment opportunity.
Rob, when do you think they're going to start delivering some price appreciation? I'm talking about Treasury specifically. The reason I asked that, Rob, is we had this conversation earlier. When do bonds start behaving like bonds? When yields start to fall because growth concerns are building so much? When do we get that?
Well, I think in terms of the bond market, we have to disaggregate the front end versus the longer end, right? And I think we see signs of some stability in the longer end. We think the curve will continue to invert. Wouldn't be surprised we get the high in yields this quarter in the longer end of the market, in, let's say, the 10-year sector. But with the Fed, committed to 75 basis points a quarter or a meeting for the next two meetings, it's probably the first quarter, second quarter next year where we get a peak in the 2-year. But we're seeing this inversion of the market, of the bond market, which will probably continue. I mean, it's a good point, though, John. I've been favoring sort of moving into investment grade in particular because of the widening spreads, and over the last several weeks or month, and we're still, we're at our wides in yield. So I do think it does make a very compelling opportunity now, even more than it has over the last month.
How do you deal, Rob, with investors, with you, clients that want short-term investments or want the ability to withdraw their cash, and longer-term investments, when even investment-grade debt is not immune to the technical selling that will come into effect if there is some sort of international event that forces people to sell what they can, not what they want to?
So I think you're referencing back to the kind of event that we had in the UK, right? Where ultimately what happened in the UK is the rise in real yields really pressured investors who were the UK pension funds who had a lot of long-dated assets and then owned these higher quality assets in this LDI strategy. They're forced to sell those higher quality assets, and I think there is the potential for that to continue, but I think in our view, we've seen a lot of the selling that's coming out of the UK pension funds. We may find some more places where we're going to force leverage to unwind, but we don't see a lot of leverage in the system this time relative to some of the past times. Or at least it's not obvious where the leverage is.
Rob, have you ever heard of leaf peeping?
I have.
I've never heard of that. I've never heard of that.
So I'm from New England and have originally from Maine. And if you're from New England, you know about leaf peeping. The peak time of tourism in Maine is sort of September, October.
Leaf peeping.
Yeah.
Leaf peeking. Yeah.
Rob Walder of Invesco. I'm in shock. Look, guys, the amount of fact checking I've had to do on this program over the years, particularly with you.
With who?
So I've Googled it, and obviously it's got its own page. I've no idea if Tom's behind this page. Leaf peeping is an informal term in the United States and Canada for the activity in which people travel to view fall in areas where leaves change colours in autumn. Tom, there's different names in different places. In Japan, this custom is called momijigari. In Finland, the season is ruska, and a trek is called a ruska trekki.
Can you see Pharaoh? Lisa, can you see Pharaoh in those LL Bean boots up to your knees, the dark brown ones, in Millinocket, Clownton, Mount Katahdin?
Okay, so we have someone writing in saying that in Boston they're called leafers. Just leafers, not leaf peepers.
People like Tom are called leafers.
Exactly, you're called a leafer. The amount of traffic, and it was kind of hilarious going up to see the leaves, was really intense, and people were kind of like, pushing each other out of the way.
Done this?
Well,
Did you get up to 110th Street?
And people were kind of like, aggressively.
Done this.
I'm not doing the peeping. I did go upstate this weekend, and it was beautiful.
You should come over to the walk-up and check the leaf peep.
It was gorgeous.
The longest trek you and I have done is from one bar to the other.
That's true.
You think we're going to go and do a trek around Central Park?
Are people shocked by this factoid?
John and Rotris and Nomura coming out from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. As Germany grapples with an energy crisis threatening its future as an industrial leader, an acute shortage of workers is compounding problems for manufacturers. The lack of qualified labor brought on by an aging population and by the pandemic is starving manufacturers from Airbus to BMW of the staff they need to keep pace with demand. Recent surveys found a record 50% of firms are cutting output due to staffing problems, and it's costing the economy as much as $85 billion per year. In Nigeria, at least 603 people have died in widespread flooding. The Humanitarian Affairs Ministry says nearly 270,000 acres of farmland are submerged in water. 82,000 homes are damaged and some 1.2 thousand people are now displaced. The flooding is expected to get worse over the coming weeks. Credit Suisse has agreed to pay $495 million to settle the largest remaining case related to its role in selling residential mortgage-backed securities in the U.S. that contributed to the 2008 financial crisis. Today, the Swiss bank said in a statement that it's, quote, fully provisioned for the payment, which will resolve claims tied to more than $10 billion in securities. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
U.S. inflation numbers are released.
The score is inflation one, Fed nothing today.
Bloomberg brings you crucial data at terminal speed.
Core CPI in America, 40-year high.
Yields are absolutely flying.
Equities down and down hard.
It's ugly.
And instant expert analysis.
What is the makeup of this inflation?
We are watching the underlying fundamentals.
Will they go 100 basis points?
The downshift just keeps getting pushed out. Now it looks like we're going into extra innings.
Nobody covers the economy like Bloomberg, your global business authority.
While my expectation is that rates are going to have to move higher for a sustained period, I do see risks around moving too abruptly to this new higher level. Moving too fast can disrupt financial markets and the economy in a way that ultimately could be self-defeating.
Esther George of the Kansas City Fed. Interesting comments, I have to say, Tom. Higher for longer, but ultimately question the speed at which you get there. Not too quickly seems to be the pushback.
Remember, we were at the Pioneer Grove with Jackson Hole meeting. She was there with a puppy pivot.
I think she told us both off
and you know
how we were behaving in the diner.
But that's an interesting theme from someone, you know, regional agriculturally based. I mean, with a different view than financial New York or financial.
Hey, some of these states, Tom, they have unemployment rates so much lower, so much lower than the national
like
average.
3%, 2%, whatever. What we're going to do here to get every time we can, the future's up 38, is talk to Jordan Rochester here in our studios, G10 FX strategist at Nomura. For Global Wall Street, frankly, this is the conversation of the day. Yen almost up to 149. Nomura doesn't have a relationship with the government, so I think you can talk freely. What is the nature of Japanese reserves? I've seen really smart articles, including from your shop, that a lot of the reserves are really immovable, and they've only got X number of interventions available if they choose to intervene. Comment on that.
Well, let's not downplay it. The size of the FX reserves is massive.
Right.
So $1.3 trillion.
But is it usable? Is it reachable?
It is usable. There's at least $100 billion in cash. So that's a significant amount for this market. And we saw the Bank of Japan, when they did intervene for the Ministry of Finance, it was large. And you saw a big drop in dollar yen. The question, Tom, is why haven't we seen them come back in with this move we've had towards, we're getting closer to 150. So we're long dollar yen right now, looking for 150. It's happening a lot faster than what I thought.
You're looking for weak yen, further weak yen.
And that's driven by policy change or just intervention off the back of that 150 pause?
Well, I think positioning is a part of it. So when the Bank of Japan intervened, it wasn't a good trade to be long dollar yen anymore because, oh my God, I'm taking on the largest central bank in terms of FX reserves in the world. So I'm going to focus on the pound, I'm going to focus on Aussie, I'll do euro. So a lot of people just took their short yen positions off. And going into that inflation number on Friday, I said, look, this is a big number. Positioning is really stretched long dollars in euro, sterling. Where's the position the lightest? It's in the yen. So that move we're having now is people putting on fresh trades and not having much to take off.
So this is short-term tactical stuff. Can we get just out to next spring? Life after Kuroda, when he steps away from this central bank. How does policy change?
The risks are we have a more hawkish Bank of Japan. But I think that they're waiting for the Fed to do their pivot. I like the puppy pivot analogy there. Hopefully we get that pivot by February, March. And then the Bank of Japan will sort of be rescued in a way. They won't need to hike interest rates or change yield curve control or be aggressive on monetary policy because the underlying fundamentals of Japan, core CPI in Japan is nearly 9 times slower than America. So there is no need to be looking the same as the Fed. But in April, we get the sort of wage negotiation data, and if it's strong, if we have second round effects from Japan, then maybe we do get more hawkish Bank of Japan going forward.
Meanwhile, over in the United Kingdom, I do want to get your thoughts on what's going on over there because you had a 5 of 5 conviction that we're going to get to, 95 on the cross by the end of the year. Have you rethought that based on some of the recent fiscal moves?
The fiscal moves are causing huge volatility, but the one lesson I learned, Lisa, from trading Brexit over the years, we were called Mr. Brexit at Nomura back in 2016, is don't trade sterling based on politics. It's too fast. You can't get an edge. And that's what's happened. If you were short sterling, long sterling, the moves have been extremely volatile. The reason we're 5 out of 5 in conviction on that short sterling view is based on the macro fundamentals. Because if you trade the politics, it's like having a chocolate teapot. It looks nice, sounds good, but it's really poor in practicality terms. Politics and trading FX only last 1 day, 2 days. For me, slowing growth in the UK, the Bank of England hiking into a recession, that makes the UK asset base look very unattractive to investors. I think this recession risk is going to get worse over winter. We'll have possible blackouts in the UK. So right now, this morning, there's a bit of euphoria because Jeremy Hunt has tightened monetary policy, fiscal policy in a dramatic way. I didn't expect the energy price cap to be changed, but it has been changed. It will end in April, the universal package. So gilts can rally because of this sort of euphoria, but I do think it's short term and we'll still be in the same situation where Europe and UK look pretty unattractive as recession risks get bigger.
So both the Japanese story as well as the British story have one thing in common, which is they're on the other side very much of the dollar story, that the dollar continues to represent the dynamism of a U.S. economy that stands out as probably the strongest in the developed world. When does that change? When does the rest of the world start to really impede on what we're seeing in the U.S.?
I think it's in February and March. That's the sort of timing I have for dollar weakness to come back in. Reasons for that will hopefully be through the worst of winter. The projections for the gas storage in Europe hopefully says we've made it. Don't worry, we're not going to have severe blackouts. And then by that point, the Fed should be approaching their terminal rate, 525, 550 is kind of where we have it at Nomura. And then from that point, the market will say, right, they've got to 550. The only way is down from here. Even though there's possible they could go higher, we can't always rule that out. But I think from that moment, the sort of US higher rates driving the dollar, the terms of trade story hopefully all turns in February, March.
Have you done momijigari in Japan?
Yes, a little bit, yeah.
Japanese leaf peeping.
Did you have to look that up again?
No, I speak Japanese. Go on, Jordan.
So we have a conference in Kyoto. It's a central bank's conference around March time. It's absolutely beautiful. All the flowers, all the leaves on the trees are white and pink, and it's one of the most beautiful things in the world.
Don't you believe me?
No.
You know what's great?
I'm very cultured.
Okay, that's great. No, I'm
Jordan,
not saying you don't speak
Do you know what's
Japanese,
great about this?
But then you're just,
Nomura flies in Devo.
Jordan Rochester. Jordan, thank you. It's good to see you.
I think that's wonderful.
Going to get some news out of Credit Suisse. If you'll take me seriously
Quite
for
the
a moment.
news. Yeah.
Okay.
Quite the news.
The investment bank chief is set to leave the company in the coming weeks amid a broad overhaul of the group that will likely see the unit cease to exist in its current form. The latest reporting from our team over in Switzerland. So he's expected, this announcement and this departure is expected to be made on October 27th. Those of you familiar with that date will know that's also when from Credit Suisse we get the bank's new strategic review. This all according to people familiar with the matter. As you know, Tom, Lisa, Credit Suisse has been a mess for a long, long time now. We've had leadership change after leadership change after leadership change, and the date in everyone's diary is 10 days away. Lisa, it is October 27th.
So how much are they basically going to have to announce piece by piece of the strategic review before it comes out in order to appease markets that are eager to hear what's next? I mean, how much can trickle out before they have to release it early at a time when you already have seen incredible credibility lost as people speculate about what gets sold and what doesn't?
Back 20 years. This guy's been through Morgan Stanley, Deutsche Bank, Goldman Sachs International for 10 years, then Lehman, then Nomura, then Bank of America, and I think that's where he finally lands at Credit Suisse. I mean, the whole IB model, witness Goldman Sachs today, and Shree's going to be on with us here, Global Wall Street, in a bit. I mean, it's almost like IB is under threat right now over what do we do next.
Well, for this particular banker, Tom, according to our reporting, he's been focusing on the overhaul of the investment bank, is now looking at options including starting his own advisory firm or joining another institution next year.
Okay.
We'll see where he lands next. That's the latest. So there you go. Much more from Credit Suisse still to come. Jordan, this was special.
It was.
Thank you, buddy. Thanks for being with us. Jordan knows I speak Japanese. Omijigari. No, I don't even think it's that. Anyway.
You just make it up. You don't speak
No, it's Momijigari.
Okay, but do you actually speak Japanese?
Sure. I haven't got enough time to practice it.
That's
Credit
really
Suisse,
cool.
where are we? There we go, up a little bit alongside futures from New York City. This is Bloomberg.
U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
From New York City this morning. Good morning to you. Equity's doing okay on the S&P 500, pushing higher through most of this morning. Last week, a week of losses, driven by Friday's move lower. This morning, Monday morning, up 1.2% on the S&P 500. Yields last week down on a 10-year a little bit, and then back up aggressively, then down all over the place in the bond market. On the week, though, a 10-year yield higher for an 11th consecutive week. What a move that's been in this bond market, Bramo. It has been relentless.
Yeah.
Higher on 2s and 10s. I think for a 2-year for 6 weeks, on a 10-year for 11.
And we've had a real shift in the psychology of a lot of investors and Fed members, especially with the CPI report yet again coming out hotter than expected. People are surprised by what they've gotten wrong again and again.
Manufacturing, Empire Manufacturing, in at minus 9.1. The survey, negative 4.3. The previous read, negative 1.5. You make much of that? Big deal?
Honestly,
as you were.
Michael McKee actually did not come on. He would have otherwise come on if he thought that it was a big deal.
He
so
was
I'm going to go
scheduled
with
to come
him.
on and didn't because...
Yeah, exactly, because it wasn't that notable. But it is slightly deteriorating. I'm not going to say more about that.
Tom's not even looked at it.
Yeah, I haven't looked at it.
I know, I'm aware.
I'm watching Dow again, 148.79. When will they intervene? Jordan Rochester just brilliant on that with Nomura moments ago. We're going to pause in usually a slot that we have at 8:31 Wall Street time on economics and look at the reality of asset management. We do this with Oliver Beta. He's the Chief Executive Officer of Allianz. He's been on a tour of duty for a good number of years to see their success. All John and I want to know is you have the football sponsorship of the soccer team, the football team from Munich as well. We see the sponsorship of sports. What's the value to Allianz, the payoff of Bayern Munich?
Oh, it's hugely positive because that's the best brand in sports, at least in our country, and we've been associated with it for many, many years. I'm very, very proud of it.
Now you have a bond bear market. Some would say your best brand and acquisition was the Gross Alarian Combine of Pacific Investment Management Company years ago. Give us an update on bond asset management and the view forward, given this great bond bear market.
Well, the current circumstances are tough, but it's very good to be with the best company in these environments, right? So we see a flight to quality over time. People are watching, but because we have a very, very long duration business model, we look forward. We believe it's going to be fantastic for PIMCO and us over the next few years as the interest rates stabilize, because the money will come back into bonds. And think about accumulation at the interest rates that we have. People often don't run a simple NPV model and say, what does it mean if you reinvest at 5% or 4.75 rather than 0?
You buried an important line there. It was in there, but it was buried. When interest rates stabilize, they're not stable. What did you make of what happened in the gilt market in the last couple of weeks? What are the lessons you've learned from that?
The first one is if you have a political idea that it's not anchored in economics, it's very dangerous, particularly if you're not the world reserve currency like the US dollar. We have learned that, number one, Brexit now will start to pay the price, and you see that. And the second thing is that markets have become to dominate again. We're coming out of 15 years of quantitative easing, no price for risk, nothing, no fiscal discipline, no monetary discipline, and suddenly that's back, and people have to get used to the fact that the laws of physics hold again, even for governments.
Well, and we were talking about how this gives room and gives rise, once again, to bond vigilantes.
Yes.
Are you the bond vigilantes? Do you actually actively go through some of the policies and say, not going to buy this company, not going to buy this nation because of what they're doing?
I wouldn't be thinking about negative selection, because that's not what we should talk about, but we're looking at countries and companies that properly manage. You know, if you have a dual deficit, think about that. 3 years ago, we had 3 times the financial stimulus in the United Kingdom that we saw a few days ago. Nothing happened in the markets, right? Nothing happened. Everybody was sleeping. And then suddenly people wake up to the fact that what has been done is really a disaster, and suddenly the prices are coming. Why is that? Because of inflation, people have started to reprice assets fundamentally, not just bonds. And by the way, we are not even at the midpoint of repricing of assets. We've just seen the liquid assets reprice. The rest will come now.
When you said actively selecting specific companies, specific nations, this speaks to the active selection that so many different fund managers talk about now as really rating supreme. Where does that leave passive management?
It's really interesting. So it is different between equity markets. If you have large cap equity, you can invest in them very effectively through index. If you're in the bond market and you don't know where things are going, you better be with the people that know what is happening and can differentiate. It's a great proof point. So I hope that all our colleagues are proving themselves now.
I'd like to repeat something you said moments ago. The liquid markets have repriced, the illiquid markets haven't yet.
Yeah.
What's that going to look like? We've spent a long time talking about pulling back the veil on some of the carnage that might take place because of 10 years worth of zero interest rates. And what we get told is that in public markets, in credit, balance sheets are strong, the resilience is there, the maturity walls is way out on the horizon, not coming soon. What's going to happen in private markets?
I'm not a great investor, so let's just start. I'm trying to be a good risk manager, which is very hard. But it's very hard to see it, and therefore it doesn't mean it doesn't exist. So people have to face a lot of scrutiny now on how the funding is. So watch out more, not just leverage, but liquidity. I think, and we saw that in the gilt market, people do underestimate liquidity traps. And that's something that we need to look for. And you see that in private equity. When people look, where are earnings really coming from? Are they trading amongst each other? Are there true exits? What are the funding structures? So it's going to go through real estate, private equity, just slow motion, but it's going to come.
The gravity's back. The risk-free rate is back as well. Talk about conservative money, pension money. Forget about LDI and the gyrations in London. Just normal institutional money. What's the shock going to be as the risk-free rate returns?
So the key thing is really, and that's what we also have to do, think about resilience, right? The point is the shocks will be harder than people anticipate. The diversification is the thing that is never there when you need it the most. So people really need to look at their models and saying, you know, how come the world completely missed out on inflation? I mean, when you think about the fact that in November of last year, we've started to buy inflation-linked bonds a lot of people were still saying, yeah, but in the middle of this was all central banks, even some of our best economies. So the question is, why is that happening? And the first answer is, I don't know why, but what I know is we have to de-risk at
So
at
how
the
do you
point in time.
de-risk? Do you just bring in duration? Do you have to change your actuarial assumptions?
Exactly.
How do you de-risk with
Systematically
adult
going,
money?
Yeah, the adult money is basically, yes, if we were, completely in an endowment, you would really selectively take risk. In this environment, we can't, with a AA rating and one of the few places in the world that AA rate, even give the impression that we don't have our tail risk under control.
Given that you're based in Europe right now, how concerned are you about the prospect that the pain that you're experiencing now, both from a business and an investment perspective, is not just going to be this winter, it's also going to be next winter. It's also going to be potentially for years to come if there is not some sort of sustainable energy plan put into effect?
So I have to be a realist, but I'm also a born optimist. Otherwise, I think I couldn't do the job, right? So the first thing is, I think,
Welcome to surveillance.
the key thing is that people, I think, have been overselling Germany, if I may say so. So I'll give you an example. We have had demand contraction on gas, 15% already this year. Now, much, for example, Italy has been only 2%. So we will have most likely enough gas to come through the winter. People do not factor that in. Now, the second question is, what will be the implication for industry to reprice its products and its production supply chains to a higher energy price? And that's happening. I really believe in our engineering capabilities, very comparable to Western Switzerland, where everybody said when, the Swiss franc was floated that all the manufacturing companies would die. No, we invest in innovation, will be very good.
Right.
The key thing is, however, we need for Europe to realize now one important thing. Germany needs to really focus on reinventing its business model. It's over with cheap energy from Russia, successful exports to China, and America providing all the security. I mean, that formula is ending. And that will require a lot of energy on the German people to fix its model, which means we have less attention and tolerance for doling out money to other people.
This has been really, really informative, sir. Just wonderful to have you in with us, but this isn't why we had you in. You people finance Bayern Munich, the soccer team in Munich. Are you guys going to steal Harry Kane from Tottenham? I mean, that's the only reason we had you. Are you going to bankroll this football team in Munich to steal the jewel of the United Kingdom?
Even if I knew the answer, I wouldn't be able to tell you.
I mean, this is in the zeitgeist right now.
That's the only reason we had the
I called up Qantas and I said, get the guy from Allianz in. I said, get him in because these are the people that are going to steal Harry Kane.
Are we going to do the show from Bayern Munich?
I think October. It says
Fantastic
like a year from
fans.
now.
I have to say, I do like the Dortmund fans too, though. They're pretty impressive.
And every fourth German is our client, so we have a lot of Dortmund
so you like
fans.
The Dortmund
we have
fans,
a lot of fans
okay.
of.
It's going to be very diplomatic.
And then Juventus, the Allianz Arena.
Cologne and Juventus.
How many stadiums do you have?
Quite a few. 12.
Can't count them.
12
across Europe or worldwide?
No, worldwide. For example, in Sao Paulo, the stadium is also branded Allianz. It's been a great investment.
Have you been there?
Amazing.
Yeah, it's really, and people pay a lot of attention. And football does something that politics can't do. This as we unite people. We bring people together. We make them enjoy their lives, regardless. By the way, most often on both sides, whether winners and losers. And therefore, it's great. It's bipartisan.
Do you realize if Harry Kane goes from Tottenham to Munich, it's un-American? I mean, that's un-American.
I've been trying to tell Tom, greatest sport in the world. Just the greatest sport in the world. Nothing close to it. It just is truly the most brilliant sport.
So why don't you come over? Regardless whether it's Juventus or Bayern, would be delighted to host you.
Well, thank you. We'll take that under advisement. Can you two have a discussion on the World Cup? First discussion on the World Cup on Bloomberg surveillance. It's like
you want to throw that in there?
Yeah.
Germany and Qatar. What are you looking for, sir? Do you think you can make it happen? Win a World Cup? Another one?
I don't know. It's a lot about passion, but it's also about the right moment. And to have the energy when it really matters. I'm certainly crossing my fingers, but the most important thing is to have a great, great, great tournament.
Can you tell FIFA we never want to do this Winter World Cup ever again? I think it's a travesty. I really do.
Lisa, what do you think?
We're taking a month off in the middle of the season to do a World Cup.
That's idiotic. That's like hockey.
It's ridiculous.
That's
doing
like
air conditioning in the football stadiums.
Yeah, interesting choice, but it is there, and so I think we're always great at criticizing things. I think we should be looking forward to fantastic
things, sir. Yeah, that's what this show's about.
Well, thank you for coming.
Oliver, it's good to see you.
The fresh air.
The Allianz CEO from New York City this morning. Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Here in the UK, the newly appointed Chancellor Jeremy Hunt has set out plans to try to bring order to the public finances and reassure markets after Liz Truss's economic programme triggered weeks of turmoil. He announced a further rollback of some of the tax cuts planned by the Prime Minister and a shortening of planned universal energy support.
No government can control markets, but every government can give certainty about the sustainability of public finances. And that is one of the many factors that influence how markets behave. And for that reason, although the Prime Minister and I are both committed to cutting corporation tax, on Friday she listened to concerns about the mini-budget and confirmed we will not proceed with the cut to corporation tax announced.
Meanwhile, Hunt will address Parliament with more details later today. Ukraine's government says Russia launched kamikaze drones this morning. The explosions hit the center of Kyiv, damaging several homes. It is the second strike on the capital in a week. In Luxembourg, European Union foreign ministers are due to agree on the launch of a new mission to train around 15,000 Ukrainian personnel and sign off an additional $487 million in weapons financing. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech and sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I definitely think we'll see another 75 basis point move in November. And, I had thought they would slow down to 50 in December, and I'm going to, cling to that for the moment. But certainly, if the inflation numbers over the next couple of months come in the way that the last two have, then it's not clear to me that they can step down from these 75 basis point hikes.
Stephen Stanley on the economics of last week and the week forward here to that important November and then on to December meetings as well into January on the Fed. It is a movable feast. Lisa Brownwitz and Tom Keene. Farrell prepares for the 9 o'clock hour. 51 points on futures. Dow futures advanced bigger, up 340, over 30,000. The VIX under 32, 31.85. It is a story that has been anticipated, written by Sri Natarajan of Bloomberg News today, and it shows not a fractured Goldman Sachs that overstates it, but a Goldman Sachs looking to the end of the year in 2023 is one big challenge. Sri, thank you so much for joining us here on the Travails of David Solomon. I'm going to cut to the chase. William Cohan's book on Goldman Sachs, Chapter 2 is called The Family Business, and Goldman Sachs has always been that emotion from the 19th century as well. Solomon is completely removed from the fabric of that chapter in Cohen's book. How threatened is he now by those that yearn for a Goldman Sachs that was a family business?
He would certainly tell you, David Solomon, that it is not a family business. They don't want to run Goldman Sachs like this partnership that it used to be. They see this as a Fortune 100 company, one that has a corporate setup, one where is one prime CEO and everyone who falls under him. Now, 4 years in, what is the mark-to-market on David Solomon? This is the third major reorganization of his business lines that he's undertaking in just 4 years in the top seat. In fact, with this one, he's undoing some of the signature moves from his last major restructuring in 2020. That, to us, definitely feels like a move that is being taken under pressure and in response to some of the criticism that senior management has faced inside and outside the firm.
What is the pressure versus a partnership board structure versus a publicly traded board structure? Is there heat from the board or selected members, or is it from the managing partners, whatever the modern phrase is of partnership?
Ultimately, you're responsible to the shareholders. If the Goldman Sachs stock had been outperforming everyone else in the financial services universe, there would be no pressure. Doesn't matter if there's griping, doesn't matter if there's complaining and grumbling inside the firm, but that's not been the case. In the last 4 years, the firm has not been able to re-rate the stock. It has not been able to get that jump over Morgan Stanley. It has not been able to get that jump relative to JP Morgan. When that happens, when there are so many changes and a CEO who's trying to change the very fabric of Goldman Sachs from what it used to be 20 years ago to what he hopes it will be down the road, it will create a certain level of discontent, and that will bubble up to the surface like we're seeing.
How much has David Solomon lost the faith, not only in investors, not only in the board, but also of people within the rank and file of Goldman Sachs?
It will be very hard to say that he has enjoyed the full and total support of his executive team. Having said that, he would argue that 4 years is not enough time. He still has a few years in him. He still has enough time to make the pivot and tell a story to shareholders and investors and analysts that actually presents Goldman Sachs as a company for the future. But when he has to make strategy reversals and about turns, it just becomes harder to land that narrative and make sure that it sticks.
What was the story with the consumer unit, considering that they've lost money consistently and now seem to be reversing?
And that's important important because one of the big changes that they're planning with this reorganization effectively involves dismembering the consumer unit as it used to be. A lot of the direct-to-consumer push that was operated under this Marcus brand name is getting shoved into this larger asset and wealth management group. The partnerships that they had with Apple and General Motors, the Green Sky fintech company that they bought last year, transaction banking will exist as a standalone business, much smaller than what it used to be, and will show losses at least for the foreseeable future.
How does someone like Apple respond to that?
Apple doesn't mind as long as they have the leverage and the relationship which they clearly have. They do not care about the internal dynamics at Goldman Sachs. But Mike Mayo at Wells Fargo gives us the best analogy. To him, what they're doing with the consumer is effectively equivalent to the demotion of Pluto as a planet.
That's so Mike Mayo. If you know Mike Mayo, that's so Mike Mayo.
Right.
Does that put Utah on Pluto? What happens to Utah Goldman Sachs after this reorg?
It stays. They are still committed to a lot of the tech stacks that they're building, and that is part of the reason why they have such a big presence in Utah. It's not so much for the call centers in Utah and Texas, but for the tech platforms that they're building.
Why now? I mean, Goldman Sachs reports earnings tomorrow. We're going to parse through them. Is this a sign that there are going to be some huge negative surprises having to do with the consumer banking unit? Is this because they are failing to deliver on the fundamental level, or is this just simply a coincidence that comes especially ahead of a new economic cycle?
Well, three things. Hopefully no surprises with respect to the consumer business, because we've been telling our readers and listeners and watchers that it is going to face a big loss-making year. At mid-year, Goldman projected that the consumer business was on track to lose more than $1.2 billion. This reorganization will change some of those numbers. But equally important, because consumer was not working the way they hoped to, they are taking it to a narrower lane and hoping that they stick it to a business that plays to its strengths. Equally important, in the last 4 years, David Solomon and John Waldron, his deputy, they had not necessarily been playing up the strength of trading and banking at Goldman Sachs, which, let's be honest, is Goldman's core business and something that they're really, really good at.
To the chase. How many days has he left? How many weeks has he left? How many quarters has he left?
I suspect the Goldman Sachs board and even his management team will cut him some slack and will have more patience for him than Tom Keene.
Okay, we got to go. Well, I'm not saying me, but I'm saying that's
all I
I'm
can
just
say.
speaking for the audience on radio and TV. They want to know about this soap opera that is Sri. Thank you. Days of Our Lives with Sri Natarajan at Goldman Sachs. Lisa, I'm looking at the intraday on yen. Guess what, folks? Jordan Rochester down to 148.62. These are teensweens moves, but they're germane here as you wonder about the intervention watch.
Yeah, the bigger question, how much intervention can they actually do? What stomach do they have for it? What reserves are they willing to use to simply stave off the declines that they see in terms of versus the U.S. dollar? The bigger question, though, is just a sea change, really driven by the strength of the U.S. dollar. And you really were good on this when you came in.
Yeah.
And you said the IMF is very concerned about this. What about swap lines? What about the shortage of dollars? What about the liquidity concerns globally? When does this become a problem that really impedes back on the U.S.? Not yet, and that's the reason why you're seeing the strengthening.
And I'm not going to go to the numbers now, but the restriction on BFCI, the Bloomberg Financial Conditions Index, tangible equity markets lift here. I don't know if it's because of yen or whatever, but futures up 51, Dow futures up 337.
I'm not going to pretend to give any narrative to this because some of the rallies recently have been pretty shocking. I think going back to what Mike Wilson said of Morgan Stanley when he was talking about the likelihood or the possibility of a 16% rally in the next couple of weeks and months heading into earnings and after, and then boom, back down to 3,200 for the S&P. Just gives you a sense of how volatile people are expecting this to be.
One question I had, I never was able to get you on this, Lisa, today. It's been so busy. There's been shifts in yield. What's the spread market done?
The spread market has widened, but not as much as you would think. You are starting to see a bit
We're
of
starting to
weakness.
see high yield distress.
Yeah, well, I mean, significant, but in certain pockets, but not as much as some people think that there will be.
A really interesting Monday. We're going to have stay with John Farrow for the idea of the Dow up 343 points, 30,000 level again on the Dow. It's good to be back. This is Bloomberg. Good morning.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
Stocks up, yields down. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. Can the U.S. weather the storm?
There's a game of chicken going on right now.
Inflation was supposed to be moderating.
Now it looks like we're going into extra innings.
When I look at the earning analyst estimates, they're still too high.
We need to see some of that weakness coming through.
That should be the next shoe that drops.
We're not going to have a typical V bottom that markets have come to expect.
It's more of a slow car crash.
If you really start thinking about what's going on in the U.S. economy,
we're in this visibility vacuum that people don't know what to do.
The Fed is trying to hike and crack the economy.
This is presenting a real challenge.
It is more about the Fed right now than about U.S. growth.
It's just this uncertainty just keeps weighing on investors.
I think this progress is just taking a little bit longer than we thought.
Joining us now to discuss all-star panel to kick off the trading week, TPW's Jay Pulowski alongside Invesco's Matt Brill. Jay, first to you, buddy. Let's start with the U.S. economy. Resilient, standing up to abuse from the Federal Reserve. How much longer can it do so?
Well, John, we've been a believer in what we call the high nominal growth rate environment. We've talked about it for most of this year. It's different from what we experienced in 2010 to 2020. A lot of investors are having trouble grappling with it. Basically, it means that with the U.S. economy growing at a nominal rate of 10% or so versus, say, 4% pre-COVID, that earnings and sales growth are going to be okay. The bar is low, 2% consensus earnings growth. And we think it's going to be met and cleared easily. And ultimately, at this point in the cycle, that's what we're at. We're at the Fed on one side versus earnings on the other. The Fed is pretty much fully priced in. We're now pricing at a terminal rate of 5%. Earnings are going to be okay. And look, the economy is growing, probably going to grow 3% Q3. Yes, it will decelerate into 2023, but it's not going to be the deep recession that people fear because there's no big structural imbalance, whether it's consumer, whether it's corporates or banks. It doesn't exist in this cycle like it did in 08 and 01.
Matt Brill, your response.
Yeah, good morning, John. I agree with most of what Jay is saying there. I think, obviously the economy can continue to do well here. And the problem is it is really like a big game of Jenga where eventually you move the pieces around enough that, everything's going to come falling down. So I think that, we're at a state where it's not too late. The Fed is on the right path. They've been aggressive. And if we can get any signs of moderation in inflation, it's not too late in the game. But if this persists, you get another 75 in November, another 75 in December, another 75 potentially even in February of next year. That's when you get to the much more difficult period of time for corporate credit.
And Matt, what should I be worried about now then? Should I be worried about growth or inflation?
Well, you need to be worried about inflation because if you can get inflation under control, then you won't have a growth problem. And so, if we can just solve the first problem, then another problem won't ever get to that point. But as long as this goes on, it gets harder and harder to do that. So for now, we got to get inflation under control. And if we can do that, everybody, we're looking at valuations that are extremely attractive. So we just got to solve this inflation issue. And that's why last week's CPI print was just so disappointing.
We'll get to the valuation point in a moment. Let's talk about the solution. Jay, to have a solution that doesn't hammer growth, you need a supply-side evolution. Do you see any evidence of a supply-side story emerging that helps this Fed out?
Oh, 100%, John, and you're right on it. Look, supply chain breakage and collapse and confusion were really the story of COVID, and that's now cleared up pretty much across the board, whether you look at ships waiting at ports or container costs coming from Asia. All that's cleaned out and out of the system. So going forward, what we have, we believe over the next several years, is a high nominal growth world driven by a global CapEx boom to deal with the 3 C's of COVID, climate, and conflict. And we see it in the CHIPS Act. Everybody wants a semi-fab plant in the region. We see it with the battery plants moving the Rust Belt to a battery belt. Everybody has to have a battery plant for EV in their region. And this is what's going to drive CapEx, and that's what's going to drive growth. We see it, and we've talked about it ad nauseum, as a analog to the second half of the 90s. We expect a productivity surge as we move away from work from home and a pretty decent economic environment over the next several years. Something that, John, virtually no one, well, recently the economists, the FT people were starting to talk about it, but the mindset of the market is nowhere near that. The mindset of the market is back to pre-COVID, which we don't think is at all going to be what turns out.
To be fair, Jay, you were hoping for a globalized synchronized recovery, a global synchronized recovery this year, and Jay, that hasn't happened. You'd concede that. So can you tell me why you think that may or may not happen in the future?
Yeah, no, I mean, I think at some point a while back we were talking about that. More recently, the last 6 months, we've been highlighting actually, John, the desynchronized global economy, both monetary policy, Fed and ECB tightening, yes, but Bank of Japan flat, standing pat, in the PBOC of China easing. So we always hear about how many rate hikes there have been. There's no talk of the fact that 50% of the biggest, most important top 4 central banks are not tightening. And then in terms of growth, U.S. and Europe slowing, yes, but Asia is picking up. Whether you look at Japan, PMIs above 50, China or Southeast Asia, China's growth is going to be better in the second half than it was in the first half. So we actually, sorry to maybe to confuse things a bit, but we've been talking about a desynchronized global economy as being a support. And as we come through the cycle, as our other colleague just said, we come through the cycle, then we have the U.S. and Europe growing, Asia growing, and we have a global CapEx boom. Because again, our tripolar world point of view. Every region, Europe, sure, Asia, the Americas, needs a semi-fab plant, needs an electric vehicle battery plant. And that public-private investment, which we've seen post-COVID, now post-energy in Europe, that's the type of thing that's going to drive the global economy in the next several years.
Jay, you talked about the top 4 central banks. 3 of them have got one thing in common. They're dealing with a weaker currency, and the Federal Reserve is driving a much, much stronger dollar. This is what the president had to say about it. President Biden saying, quote, "I'm not concerned about the strength of the dollar. I'm concerned about the rest of the world. Our economy is strong as hell." Mike McKee, the problem is the rest of the world is concerned about the strength of the dollar.
Absolutely. Down at the IMF meetings in Washington last week, there were 3 villains: COVID, the Russians and the dollar. The dollar, a side effect of the Fed's inflation fight, but one that is very important to the rest of the world. You can see that strong dollar periods coincide with slow global growth, and there's an IMF report out that says we could see, in a worst-case scenario, just 0.5% growth. Now, a global recession is somewhere between 1% and 3%, so 0.5% would be very bad news for the rest of the world. The IMF says about 60% of countries out there are in or near financial distress. Now, what happens? Well, the U.S. obviously has higher rates, attracting global investment. It's seen as a safe haven for investors, so anything that goes wrong, people want to put their money here, which means the U.S. exports inflation through trade, and the world pays more for commodities priced in dollars. So there is a problem out there. There's another problem for the president, though. The strong as hell thing? Maybe not. Today, Bloomberg Economics put out a new report that said the chances of a U.S. recession in 2023 are 100%. You get 60% from the Bloomberg survey of economists and 25% from the New York Fed. But you have to look back at when recessions start, at what level. The New York Fed is basically predicting recession. So are economists. It doesn't look good for strong as hell as the Fed continues its inflation fight. Biden needs a soft landing. The Fed would like one, but it doesn't look like, at least to the economics profession, that we're going to get one.
Mike McKee, thank you, sir. Let's pick up on that quote again from the President of the United States. I'm not concerned about the strength of the dollar. I'm concerned about the rest of the world. Our economy is strong as hell. There's 2 points here. Matt Brill, let's go to the first one, and then we'll get to the second one. I'm not concerned about the strength of the dollar. I'm concerned about the rest of the world. What's your response to that, Matt?
Well, you know, as for the rest of the world, you've obviously got issues going on in Asia. You've got issues in the UK. I think that as far as the strong dollar, it never leads to a good market. It's debatable whether it leads to a good economy, but it doesn't lead to a good market. So we need the dollar to get hit here. We need the dollar to soften up in order for risk assets to reverse. So I think if you can get the dollar to reverse at all, then you're going to do well. But we just haven't gotten to that point yet, and because the Fed has to keep hiking, which is going to be good for the dollar. So it's a little bit circular here, but I'm thinking I think he's wrong with this, that he should be more concerned about this than he is.
Our economy is strong as hell. Now, Matt, I guess it's a relative game, and relatively speaking, compared to others, it may well be. What do you make of that statement?
So he's absolutely correct. It is today. The question will it be there in 3 to 6 months? And I still think that, it comes down to this inflation expectations. And if you can get things under control, then they are out the curve expectations. We saw this, Michigan survey. I know you're not a huge fan of it, but seeing 500 people tell you what they think inflation is going to be over the next year, whether or not that matters, I don't know. But if you look at five-year forwards, they're certainly under control. So that is good. The economy is good now, and it's just the second derivative is starting to take place, so it's increasing at a decreasing rate. I think Biden, he's got an inflation problem. He does not have a growth problem. So he's going to tout the growth as much as he can while it exists. And right now, it still is very strong.
Matt, you brought up Mitch, so we can go there. This is not about me. This show's about you. Mitch, 1 year inflation expectations, I believe, rose to about 5.1%. Matt, it's not for me to sit here and say, and I think these conversations often drift in this direction. Sit here and say what the Fed should or shouldn't do, what they should or shouldn't look at. They tell us they look at Mitch. Matt, they tell us they look at the ECI. They've told us they've made moves based on those two prints in the past 18 months as well. What's special about that move, Matt, getting back to 5.1%? What do you think it triggers within the Federal Reserve?
Well, I think it does make them certainly cautious, and they're seeing just no signs of victory thus far. And I think that's the biggest thing. The biggest takeaway is that if the Fed looks at 50 different things and not a single one of them tell them that they're winning, then that's not good. At the end of the day, the market really only cares about the CPI print, in my opinion. I mean, there's going to be others that matter. They're all undercards. The main event is the CPI print, and so we have to wait another 4 weeks until you get another CPI print. And so, for me, that's what the market's going to be looking at. The Fed can tell you all these other things, but all we really want to see is some signs that things are getting better, and we just haven't gotten them yet.
It was a knockout blow last week. Jay Pawlowski, just a final word on this one in this segment. 75 in November from this Fed.
Yeah, that's a given, John.
Jay Pawlowski, Matt Brill sticking with us. I think everyone is on that page right now. Coming up, trouble down to the UK. The Chancellor, Jeremy Hunt, ripping up the PM script.
There will be more difficult decisions, I'm afraid, on both tax and spending. The most important objective for our country right now is stability.
That conversation up next.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Taken together with the decision not to cut corporation tax and restoring the top rate of income tax, the measures I've announced today will raise every year around £32 billion. There will be more difficult decisions, I'm afraid, on both tax and spending. The most important objective for our country right now is stability. This government will therefore take whatever tough decisions are necessary to do so.
UK Chancellor Jeremy Hunt scrapping the Prime Minister's fiscal plans as Governor Bailey gets ready for a big rate hike.
The very clear message I would give, and it's a clear message for everybody, including it's a clear message for markets. I can tell you there is a very clear and immediate meeting of minds on the importance of stability and sustainability.
We will not hesitate to raise interest rates to meet the inflation target. And as things stand today, my best guess is that inflationary pressures will require a stronger response than we perhaps thought in August.
Team coverage starts right now with Guy Johnson in London alongside Lizzie Bird. And Lizzie, first to you, what a U-turn from this government.
Yeah, Jeremy Hunt's absolutely nuked Trussonomics here. You've had massive U-turns, more U-turns on even more of her tax cuts. And almost as humiliating, the energy bailout has been limited, so it's now going to be reviewed in April. It's going to be more in line with other European governments. Of course, it was really expensive. It was going to cost £60 billion estimated in the first 6 months. And what's humiliating about that is that even when Truss was having to U-turn on the top rate of income tax, corporation tax, she taunted Keir Starmer, the opposition Labour Party leader, that her energy bailout was bigger than his. And now she's kind of admitting that she's going to have a more targeted package so that businesses and rich households aren't having their energy bills paid for unnecessarily. The question is, do middle-income households who needed help become the baby that's thrown out with the bathwater? But notably missing from all of this was a reversal on the lifting of the cap of bankers' bonuses. So we'll have to see whether that's mentioned when Jeremy Hunt makes his statement in the Commons later on this afternoon.
We hear from him later this afternoon and then later on this month as well. And Guy, in early November, we hear from the Governor of the Bank of England. in the decision we expect to be another big rate hike. Kit Juice of SocGen said, goodbye crisis, hello recession, Guy. The vigilantes win.
In some ways they do. Westminster is now basically being dictated to by the gilt market, by the City of London. Interesting relationship, considering we have seen that trade very much working in the other direction for a very long time. That's the trade right now. The Bank of England, if you look at current pricing, John, we have come back down to probably circa around 100 bips at the next hike. We are probably going to get up to around 5 to 6, somewhere in the middle. Let's call it 5.5 in terms of the terminal rate. It may need to be higher. What is interesting from the Chancellor today is he's gone further than maybe the fiscal hole would suggest that he needs to, suggesting that there has been some damage done, and he's talking about having to go even further. It's a wholesale reversal. I agree with Lizzie that the energy story is going to be an interesting aspect to all of this, and the bank will have to think about that as well, because that's going to limit the demand story coming out of the UK at the moment. It will hit consumers into next year when this program starts to roll off in April. So that's going to have to be factored now back into the Bank of England's thinking on how far ultimately it can go.
Guy, I wonder if there's a difference between what the government wants to signal right now and what they're actually intending to do. Do you get the sense that they said April 2023 because they want to signal maybe a tighter approach to fiscal policy over the next several months, but they're fully intending to revisit that in the months to come?
I think facts will dictate that, John. We'll wait and see how tough this winter is. We'll wait and see what the situation looks like at the beginning of the next year. They have written a very big open check to the energy market, like so many governments have done around Europe. I suspect that this may give them actually a little bit more flexibility in terms of their ability to manage that process and be able to deal with what happens next year. I was talking to Maria Tadeo just a moment ago. She was talking about the fact that European politicians, they can't think beyond this winter. They know that there could be a problem further down the road, but at the moment, we just need to manage what is happening here and now. Let's see what the picture looks like in April. Maybe they do need to continue with it, maybe they don't.
It's a huge problem. Lizzie, Guy, what a couple of weeks for you guys, to the two of you. Thank you. Matt Brill, the bond vigilantes are back, and Kit Jukes of SocGen says the bond vigilantes win. I have to say, I've mentioned this a couple of times over the last couple of weeks, I can't remember a big change like this off the back of a market move in G7. In fact, maybe you've got to go back to Berlusconi and the Italian government and the Eurozone debt crisis when he got toppled. What do you make of this, Matt? The fact we've got the bond market, the pressure is back from the market to politicians in a way that it's been absent for much of the last 10 years.
Yeah, it's great for the longer term, absolutely, for fixed income. It feels nice to have a win in the fixed income camp for once this year. But, if you look, related to the U.S., at some point here, there's going to be discussion on whether, where the U.S. stands fiscally and do they need to be, tightening their belt. And I think this takes that off the table of somebody coming through with a very large tax cut or a very large spending increase. I think the bond market it doesn't have to do this in the U.S. because of what you've seen in the UK. So hopefully we can avoid some volatility down the road, because I think this is the power that politicians need to see. And I think it's very healthy for the long term of the bond market.
Matt, I heard from several people in the last month or so that USIG was getting pushed around by what was happening with the pension industry and the crisis in UK markets. Any truth to that, Matt? And what does it mean now that the UK Chancellor has come out and done what he's done?
Yeah, it did. And in its simplest form, there wasn't enough long duration assets for UK pensions to buy. So they used some synthetics in order to do it. That caused leverage, and then they got offsides on that. So what they had also bought, though, because they couldn't buy it in the UK, was they bought long duration assets in the US. And so they were buying long duration corporate credit, and they had to sell it. And it was one of the few things they could actually get liquidity on in a short period of time. So we were seeing massive VWICs coming out, portfolio trades that were being done $1 billion at a time that were the market or the dealers just weren't ready for, and they didn't want to absorb it. So it really put a lot of pressure on corporate credit. Once we've got a little bit of reprieve over there, it's helped us. So for now we've got 99 problems, but gilts aren't one of them. But it's finally to the point where we're not selling off because of them. In fact, you got a 40 basis point plus move in long end gilts today, which is not healthy or not normal, but we'll take it for today. We just want some stability out of there, and then we can get back to trading where we think we should be on our own merit.
I'm not sure Jay-Z thought he was getting a shout out in the corporate and sovereign debt market this morning. Jay, I want to finish on Europe with you. You and I have talked about it together for so long, so many years. Guy's point on tightening up the duration of assistance to offset the pain in the energy market, and now it's only going to April 2023. Jay, the commitment of these governments in Europe to support the electorate through a difficult time. Are you worried about the duration of it, considering this is going to go on potentially for more than one winter?
No, not at all, John. Look, we're big fans of what's happening in Europe, and I think part of the issue for the UK is, life post-Brexit is not easy. It's a small economy. It's a relatively unimportant economy. It's on its own, and it suffers as a result when it makes a policy mistake and markets react. It's really been what we called it 2 weeks ago, a tempest in a teapot. For Europe more broadly, look, all this is driving further integration. Now you're talking about Europe doing a unified missile defense shield. I mean, things that were unthinkable even 2 years ago. So we continue to be very constructive on Europe on a medium-term basis. Anybody with strategic money to deploy over a 3-5 year basis, Europe is trading the currencies 40% cheap. Stocks have never been cheaper versus the U.S. Integration is progressing apace. They have more fiscal support than the U.S. It's already pre-baked and is going to continue. And look, I think we're moving towards a Europe that issues debt in its own as a unified union. And as that happens, that's very constructive for the euro. That's very constructive for fiscal responsibility within Europe. And I think, to me, Europe, I said it before, and I continue to believe it, Europe has a chance to win the decade of the 2020s, particularly when you look at Asia and where the U.S. is.
I've got to frame what you just said.
Please do. I've said it many times, and I continue to believe
of what's happening in Europe. Jay Pawlowski, I'll frame it, and then we'll replay it in a few months' time. Jay Pawlowski, Matt Brill,
couple of years, buddy.
You want 2 years? You can have a couple of years. Coming up, the morning calls and later, Bank of America, the latest to report results. That conversation with Ken Leon of CFRA and PIMCO's Erin Brown just around the corner.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Live from New York City, here are the morning calls. First up, JP adding TJX to its analyst focus list, saying the retailer historically outperforms during economic downturns. Morgan Stanley upgrading Clorox to equal weight, expecting margins to rebound as pricing pressure starts easing. And finally, Credit Suisse downgrading Fox to neutral, seeing an unfavourable backdrop amid growing recession risk. That stock is down by more than 5%. Coming up, more earnings from the big banks. PIMCO's Erin Brown recommending investors raise cash and remain defensive. That conversation up next, the opening bell just around the corner.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London.
I'm going to be watching retail earnings from both Home Depot and Walmart.
Then surveillance for in-depth analysis.
Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro.
Across the board, these are good numbers.
The big headline there is reaffirming the outlook.
How much does this give faith that you can get some sort of resurgence in consumer spending?
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Four seconds away from the opening bell in New York City this morning. Good morning to you. Futures are positive, really kicking higher. Session highs up 1.8% on the S&P. On the Nasdaq 100 up by about 2.4%. On the Russell, the small caps up by 2 full percentage points. Off the back of a week of losses, looking to kick off Monday morning with a session of gains. Switch on the board and get to the bond market. There's your opening bell for equities. Yields are lower by 8 basis points on a 10-year, 393.85 over the previous 11 weeks. Yields have been climbing on a 10-year for 11 consecutive weeks. On a 2-year for 6. Unreal moves in this bond market. 2s all the way right out through the curve. In the FX market, euro showing some strength. Euro dollar up 0.6%, 97.84, and crude 86.70, up by around about 1.26% this morning. One stock to watch: Bank of America positive in early trading by about 5 full percentage points. For more on this, let's get to Bloomberg's Shonali Basak. Hey, Shonali.
Good morning, John. You're looking at Bank of America stock absolutely soaring early in trading, and it's because they're delivering above expectations on net interest income. And even though costs for the year are a little higher than expected, investors are showing you if you make money, you can spend some money. And so what does that mean? Headcount has increased slightly as well by the thousands, as it has in many of the other firms. But you're also seeing them say that they don't have plans right now for reduction. So again, welcome news. They're trying to stay competitive. They're seeing the consumer quite healthy here. You're also seeing FICC and equities meet or beat expectations. And so trading coming in above expectations, even some weakness being seen there in some credit and mortgage products. How that fares tomorrow for Goldman Sachs is of key interest, because we're going to want to see them punch high on equities after what we saw at Morgan Stanley and JP Morgan kind of missing expectations there, and fixed income coming in strong across the board. Shifting over to Goldman Sachs, of course, that big news this morning about another reorganization around the corner. They have their earnings tomorrow as well. Key changes being unwound. They're merging again asset and wealth, because the wealth customer, of course, has a slightly different profile, but consumer banking businesses will be in a bit of a separate region here in the bank, platform services area being created at the bank run by Stephanie Cohen, according to Bloomberg's reporting. So the big key question here is, fine, you have a reorganization at play, but what will this mean for the high hopes that David Solomon has hoped to hit $4 billion in consumer revenue by 2024? They're expected to meet $2.3 billion this year. Will he change his expectations as he addresses analysts tomorrow is the key question.
Shonali, what am I more interested in tomorrow? Their numbers or the man delivering them?
The man delivering them, and it's not just the man man himself. This is year 4 of his tenure, John. We're getting very, very close to year 5 of his tenure. This is the part of the history here for David Solomon where you start to take note. They've come in above expectations on returns on equity consistently. Their bank, however, is trading below book value. How does he get the multiple that many of his rivals are getting? Is the investment bank simply not enough for Goldman Sachs to give investors what they want?
Shanali, looking forward to your coverage through tomorrow. Shanali Bassett will be on with us on Bloomberg Surveillance. We break down those numbers for you. Sticking with us on the banks is Ken Leon of CFRA. He joins us now. Ken, was fortunate to catch up with you last week. We get to do it again this morning. Just your view on Goldman, the leadership, the direction of travel as we go into tomorrow numbers.
Yeah, so analysts are still listening to Bank of America, but top of mind is Goldman Sachs. And for Goldman, you know, I really think James Gorman at Morgan Stanley has a chuckle here. He's got the right strategy. Goldman just reached too far trying to get scale from nowhere in consumer banking. And obviously that has a good long-term opportunity, but they can't bring it to revenues or profitability. Gorman, of course, acquiring E-Trade gets the workforce. They're able to get into different segments of wealth. And the market, as Shanali mentions, pays a higher multiple for principal businesses or recurring revenue. And unfortunately, investment banking is going to be challenging through next year for Goldman and others. And they're essentially combining businesses with trading so that they can begin to cut costs.
So, Ken, what are you saying? Are you saying it's the wrong strategy? Are you saying they should have brought this? They shouldn't have done it organically? Does Marcus need to go? Ken, what are you saying they should do?
So Goldman is always a brilliant, best in class, but they basically have an agency businesses, and they see others like BlackRock or Schwab or even Blackstone enjoy the benefits of scale and recurring revenue. In a very cyclical business, which will be down through next year as investment banking, they don't have the #1 wealth business as Morgan Stanley has, or the broad scale that Bank of America has in commercial and consumer lending, or JP Morgan. We have buys on Bank of America and Morgan Stanley. We took Goldman Sachs from a strong buy down to a hold over a month ago, just feeling that the agency business is just not going to come around. And it's a big leap to say that you can, you know, have a slightly higher rate to a consumer that's a spender or a saver, but not yet an investor for the long-term trend. That was really a tough strategy.
Ken, Bank of America right now is up by more than 5%. Can I just ask you, for these big banks like BofA, are higher interest rates good or bad for them in the next 12 months?
Yeah, we stay with Bank of America because, as you know, essentially, if you have a large, high-quality loan book, you can sit back and enjoy rising rates. But obviously, the risk is any cracks or severe recession next year. We will have recession. If it's not severe, what Bank of America said is we're going to add another $1.25 billion of net interest income in the fourth quarter. So that was always part of the bull case, which was rising rates. But you know, unfortunately, next year, economy is going to slow down, and that makes it a little more tenuous. And then the capital markets, you know, we like, and I think a lot of portfolio managers like regional banks over the large banks because of geopolitical risk and also underperforming in investment banking.
Ken, what we're used to in a recession is a central bank cutting interest rates. And when we backtest and look at how these banks respond to downturns in economic growth, usually that's supplemented by interest rates being cut at the Federal Reserve. Ken, have you given thought to a cycle where we get a recession, the Fed doesn't cut, and what that actually means for the banks this time around?
So they will then be part of perhaps, you know, a new bull market or a recovery of the economy, and we're not there yet. And, you know, there's a generational rise of inflation. Many investors have not been around since we've seen the 1970s or 80s, and the Fed's credibility is at line. So I think, you know, we're looking at 75 basis points in November, maybe December, and, you know, that's the challenge. I think a lot of us hope that the Fed will ease, but, you know, there's a lot more work to be done. And unfortunately, that's not great for the financial sector or banks until we see them pause.
Ken, awesome to hear from you this morning. Thank you, sir. Ken Leon there of CFRA. Bank of America positive by 4.7%. A broader story 6 or 7 minutes in. We're up and away on the S&P 500, up by 2.5%. On the NASDAQ, up by 3% and some. PIMCO's Erin Brown says stay defensive. She writes the following: companies have to navigate an extremely difficult environment where demand is slowing, fading, and cost pressures persist. Thus threatening margin contraction. We are underweight more cyclical sectors and favour high-quality companies at reasonable valuations. Erin joins us right now. Erin, thank you for your patience as we work through the financial stuff. Let's get to the equity market. Big move higher. Are you saying you'd fade this?
I absolutely would fade it. I think that the market right now is just coming off of, very strong weakness over the past week. We see a little bit of a relief rally this morning, but I wouldn't extrapolate that this is, going to last a very long time. I still think that there's significant challenges ahead as we turn the corner into early next year that the market hasn't digested yet. Earnings estimates are too high, margins expectations are too high, and I don't think that equities are still, singing the same from the same hymn book that we see in the fixed income markets. You saw a very negative reaction last week on the CPI print and sort of follow on into Friday. And I think what you're seeing is that the market is still fearful of higher inflation and still believes that higher inflation is going to, lead to or accelerate a recession. And I think that that's the challenge that the market's still facing that we, we'll see unfold over the next couple of months. So I still think that there's about 10% downside from current levels to S&P 500.
Erin, in the near term, is there some upside at all? In the very near term, because Mike Wilson of Morgan Stanley shares your view, ultimately, that there's more downside here, and maybe we could get down to 3,400. But he wrote this morning. He said the 200-week moving average is a serious floor of support until companies fully confess or a recession officially arrives, both of which could take several more months and lead to a technical rally in the short term. Erin, you've given me your fundamental thesis. What about your more technical, tactical thesis about the short term? The scope for an upside move here?
Yeah, I definitely think that there's scope for upside move. A lot of people are pointing to that 200-day moving average. On top of that, earnings expectations for this quarter are quite muted. There's only, sort of low single-digit earnings expectations. While earnings have been coming in slightly weaker than expected, the bar isn't that high. And so, going into what typically is a very strong seasonal quarter, which is the fourth quarter, and into, a fairly muted earnings season, there's certainly potential for upside, but, it's hard to time that, and I would be fading or selling into any of that upside move that you see in the market on what I think is largely a technicality.
What's going to lead you to drop your neutral stance on duration away from the equity market, Erin?
I think we're getting closer to that point. I think you really need to see a couple of things happen to get more bullish duration. The first would be to see inflation really peak and have a credible path lower for inflation. There's been sort of 3 times now where we've had these head fakes with respect to inflation peaking, and yet we've been met with disappointment. And so I think until we see credible signs that inflation is really moving lower, it's going to be hard to really, put your neck out there and buy duration and size. But given the valuation levels, given these real yield levels that we're seeing today, it is arguably a pretty attractive alternative to other asset classes. If you think about it, historically, your starting point for yield today is what the market should bear over the next 10 years or so. So given, the starting point of 4.4% on the 2-year and just below 4% on 10 years, that's a pretty good return that you're getting from cash and duration over the next 10 years, albeit with volatility in the near term.
Erin, just a final question on that. I hear a lot of people say raise cash, stay defensive. With the benefit of hindsight, that's super useful 12 months ago. Erin, there's people watching this now who just don't want to monetize the losses this deep into the hole. How do they raise cash?
I think that we're still going to see downside from equities from here. So I think taking money here out of the market and putting it in a 4%, 2-year paper still makes sense. And I think that, alternatively, looking at high investment grade corporates that are also yielding, a 6%, 7% yield also makes sense. Staying, shorter term in duration. But if you expect more downside from here, yes, it's painful. Use that to tax loss harvest, and cycle that money back into products that can earn a sustainable yield and return over the next 6 to 12 months while you wait it out.
Erin, awesome to hear from you, as always. Erin Brown there of PIMCO. Your equity market about 11 or 12 minutes into the session, up by 2.8% or so on the S&P. Big move higher on the NASDAQ, up by 3.33%. Coming up, the White House drumming its support behind the Fed.
The big concern is, can they bring down inflation while maintaining a robust economy, labor market? We are starting to see signs that the actions they are taking is having an effect.
That conversation up next, plus we'll catch up with Oppenheimer's John Stolfus. His S&P 500 price target getting chopped from 4,800 down to 4K. We'll get to him next. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. You know, and the ultimate output for a company is share price. You know, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
This is Bloomberg.
What we can see in the economic data is the Fed is focused on bringing down inflation, and the big concern is, can they bring down inflation while maintaining a robust economy, labor market? And we are starting to see signs that the actions they are taking is having an effect.
Division down in D.C., there always is. The Biden administration back in the Fed saying its policies are starting to work. Senator Bernie Sanders seeing a different picture.
I think they're hurting the situation. I think that it is wrong to be saying that the way we're going to deal with inflation is by lowering wages and increasing unemployment. This inflation thing is a real issue. It is a global issue. But at a time when working families are struggling and the people on top are doing phenomenally well, I don't think you go after working people.
Mike McKee with us here in New York City. Mike McKee, the usual suspects maybe Senator Warren, Senator Sanders, but ultimately we're expecting more of this, aren't we?
Yeah, it's starting to be a debate in economic circles as well as people start to think about what could happen. It's not happened yet, but Bernie Sanders has some support, particularly among progressive economists. Claudia Sahm, you've heard of her. She's fairly grumpy about things right now. She says the world's bad and will worsen at home and abroad before it gets better. Time for the Fed to do the right thing and slow down. Is the Fed going to do that? Well, not what they're telling us, it does suggest, I mean, in the past, that there is a danger of what Bernie Sanders and Claudia Sahm are talking about, because when the Fed raises interest rates, unemployment goes up, we go into recession. The Fed so far raising interest rates, though, and it hasn't happened, and that's the dilemma for the Fed. They believe that people are better off if they bring down inflation, even at the lower end, because while people are making more money, they are not making enough to keep up with inflation. So if inflation comes down, then everybody is better off. And so that's the goal for the Fed going forward. They're going to watch the unemployment rate, but they think it'll only go to 4.4%. That isn't very much by historical standards, and it may be about normal. We may have a tighter labor market than people think. So it's something that has to play out over many months now, but it is definitely a growing debate, particularly down in Washington.
We're going to have this conversation a whole lot more going into the midterms, no doubt, in the next couple of weeks. Mike McKee there here in New York City. And great work, Mike, last week in D.C. More bulls throwing in the towel, kinda. And I'm going to get to the kinda in a moment. But Oppenheimer's John Stolfus was at 4,800 year end. He's chopped that down to 4,000. His price target now is 4,000 year end. And I'm happy to say that he's given us a bit of time this morning to talk about it. John, great to catch up, sir. Thanks for taking the time to be with us. So let's start here. You know, I've talked about this a few times over the last few months. What was the straw that broke the camel's back on this one?
I really think it has simply been that we have seen repeatedly these rallies that we've had that have been remarkably powerful based on the negativity that's out there, and then they weren't sustainable. And it simply weren't sustainable because the issues at hand, whether it's monetary policy, a generally more aggressive stance and committed stance by the Fed to curb inflation, as well as political dysfunction in Washington and abroad, the geopolitical stuff, supply chains that are still not quite up to pre-pandemic levels. All this, it gives pressure and concern to the market. So what we've got to think is, 12% upside from here to the end of the year makes a lot more sense than almost 33% upside based on where the S&P closed on Friday. So we're still bullish on equities. It's just going to take more time until the Fed has effect on curbing inflation, because those last numbers from last week, the 30-year yield, the 30-year mortgage yield last week going up again, just doesn't look like it's had effect yet. We believe it will have effect, but not yet.
John, you and I have talked about this and discussed it through the year. Not everyone gets the year right. That's just part of the game sometimes. But, John, you got it dead wrong. And I just wonder what you feel like you did get wrong and didn't learn from quickly enough. As you reflect on this year and think about the years to come, how will you and the team grow from it?
Well, the first thing I'd remind you, John, we've been pretty accurate over most of the 10 years that I've been here at Oppenheimer since 2012 in terms of the direction of the S&P 500, except for 2015, 2018, and this year. So not a bad record. And last year, our target was 4,700. The S&P closed at 4,776, as I recall. This year, we got it wrong very simply. We could not have expected the Russians' incursion into Ukraine, zero COVID tolerance by China that closed down the city of Shanghai, a city of 25 million people, plus the effects of overstimulation by the Fed and by politicians who just couldn't let go of the fiscal policy.
The reason I asked, John, is because 2015 was a down year. 2018 was a down year.
Yeah,
and what worked last year was just being
flat.
What worked last year was just being bullish and strong, and what worked for the last decade was to be bullish and strong. And John, I just wonder if we're all adapting to a new market regime, a real change.
Well, the big regime is it's the end of free money, and the end of free money means you're deleveraging in a wide variety of areas that have inflated the valuations of things like meme stocks, cyber currencies, as well as even core assets like equities, bonds, real estate, and a number of other assets. When you take out the leverage that the Federal Reserve has enabled and the largesse of politician stimulus, it means that things move back to reality. It doesn't mean stocks can't move higher. It doesn't mean companies can't earn money, but there's a period of adjustment that we've witnessed here that is taking longer. When you look at the Fed has raised, 5 times so far? and still has had very little effect on the rate of inflation. And that's where we are. The market's responding to that.
John, 300 basis points in 6 months is a lot.
Oh,
We've
sure is.
We've had a lot done in a small period of time, I get that. But I just want to really sort of hit home on this, and you and I can talk about it in the future as well, because we don't have too much time. But being married to a worldview in the last 10 years generated some real gains. And if you were just long the whole decade, you would have been down in 15, it was a down year, 18, it was a down year. Now I feel
was
like
basically flat.
Sure, it was a flat year, slightly negative by about 0.7%.
Dividends was actually positive.
We can argue over the details, John, but you know where I'm going with this. I'm just wondering whether the perma bulls have got to rethink their worldview based on what's happened over the last 9-10 months.
I'd say we were not perma bulls, but rather we were positive on a pretty obvious situation. In terms of moving forward, we think past performance no guarantee of future performance, would suggest that once the market gets used to this new regime of a world in which bond issuers have to pay for the privilege of borrowing money, and bond buyers get paid for the risks they take, and that moves through the credit facilities, of course, affects equity returns, the market is likely to return to a more positively adjusted basis. You know, I've been doing this for 39 years, so I can remember where interest rates were a lot higher than they are now. Bonds were yielding yields much higher than now, and stocks were moving up.
Hey, John, credit to you for coming on with us this morning. I appreciate you know that. We're going to have a longer conversation in the future. John, thank you, sir. John Stolfus there of Oppenheimer from New York. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Really powerful start to the session. Stocks up big time. Let's get to the trading diary. The White House press secretary speaks at 1:30 Eastern. Earnings season ramps up with Goldman and Netflix tomorrow. Plus Fed speak from President Kashkari and Bostic. The Fed's beige book on Wednesday with Bullard and Evans on deck. Initial jobless claims coming up on Thursday. From New York City, thank you for choosing Bloomberg TV. That does it for me. This was the countdown to the open. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok influencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account
than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar